Hey everyone, welcome to the channel where we simplify self-employment retirement planning. If you are self-employed, a freelancer, or a small business owner with no full-time employees, this one's for you. Today's daily webinar is for educational purposes. Go ahead and shoot over any questions you might have so we can go over those during this morning's webinar. Whether you have a question about contributions, distributions, or investments regarding what types of investments can be held in a solo 401k to any other topic. We're also well versed on self-directed IRAs as well as the business financing 401k, also known as a rollover business startup 401k. So today's topic might sound simple, but it has some important layers. The topic is a solo 401k taxable? Short answer is sometimes yes, sometimes no. But don't worry, we'll break it all down. Give me just a moment here to make sure I check the voice, or volume, I should say. Okay, in this webinar, here's exactly what we'll uncover to help you save on taxes and avoid surprises at retirement. We'll start by explaining how a solo 401k is structured and why that matters for taxes. Then we'll cover two major components: pre-tax versus Roth, solo 401k contributions, and also touch base on voluntary after-tax solo 401k contributions and how these contributions impact when and if you pay taxes. We'll also go over what happens when you distribute money from your solo 401k, including required minimum distributions. So by the end of this webinar, you'll know which part of your solo 401k grow tax-free, which are taxable when withdrawn, and how to structure your plan to maximize your tax savings. So if you've ever wondered, will I pay taxes now or later, or can I avoid taxes altogether? Hit that subscribe button and let's dive in. And again, go ahead and shoot over any questions that come up during the live presentation, and we'll go ahead and take a look at those. So a solo 401k plan is for the self-employed. And Congress created all 401k plans, including solo 401k plans, for individuals to save for retirement. In order to qualify for a solo 401k plan, you have to be self-employed. You also cannot employ any non-owner full-time W-2 employees who work 1,000 hours or more in your business. Of course, you can exclude those who are under age 21, as well as independent contractors, regardless of how many hours they work. So again, from an eligibility perspective, in order to qualify for a solo 401k, you have to be self-employed and not employ any non-owner full-time W-2 common law employees. So the way a solo 401k is structured is that it allows for various types of contributions. It allows for pre-tax solo 401k contributions. It also allows for Roth solo 401k contributions. And of course, it also allows for voluntary after-tax solo 401k contributions. So various types of contributions are allowed to a solo 401k plan. Now, let's talk about the components of a solo 401k from a contribution perspective. So you have pre-tax contributions. So pre-tax contributions means that when you make a contribution to the solo 401k plan, it's on a pre-tax basis, which means you're going to be able to reduce your taxable income for the year. So that's the advantage of pre-tax contributions. You get to save on taxes now because it's going to reduce your taxable income for the year. The flip side, however, is that those funds will be taxable once they are distributed. That is, those pre-tax funds. So they're going to grow tax deferred. So they're going to have many years to compound. However, when you go to take distributions of those pre-tax funds, including the contributions and the earnings, those are going to be subject to federal taxes at minimum and possibly state taxes depending on your state of residence. Now, with respect to Roth solo 401k contributions, those are made with after-tax money, which means that, yes, they're still made based on your earned income from self-employment activity. So you have to have earned income to make solo 401k contributions, whether pre-tax contributions, Roth solo 401k contributions, or voluntary after-tax solo 401k contributions. When you make a Roth solo 401k contribution, specifically employee Roth solo 401k contributions, you don't get a tax deduction on that contribution because it's made with after-tax funds. However, those contributions and the gains on those contributions will grow tax-free. And therefore, once you make distributions from the Roth Solo 401k plan, that is, once you satisfy both of the following requirements: A, you are age 59 and a half and have had that Roth Solo 401k for 5 years. Those distributions from the Roth Solo 401k will be both federal tax free, and you will not have to pay state taxes either, regardless of your state of residence. Now, we talked about employee Roth solo 401k contributions. There's also a new contribution type, a new Roth solo 401k contribution type stemming from Secure Act 2.0. That one is referred to as a Roth solo 401k employer contribution. That one's a little bit interesting in that when you make that contribution, because it's an employer Roth solo 401k contribution, it's going to be tax deductible on the employer side. So on the employer tax return. For instance, if your self-employed business is taxed as an S corporation, if you make an employer Roth solo 401k contribution, that contribution is going to be deductible on your business side, so on the Form 1120-S tax return. However, on the flip side, it's going to be considered a taxable conversion on the personal side. So you're going to have to pay taxes on that employer Roth solo 401k contribution on the personal side, which may bump you into a higher tax bracket. However, those funds will grow tax-free as well, and you'll be able to distribute those tax-free once you meet those same requirements I touched on earlier that also apply to employee Roth solo 401k contributions, which are you need to have had the Roth solo 401k for at least 5 years, and you have to be age 59 and a half or older at the time of distributions. Now, the third type of contribution is a voluntary after-tax solo 401k contribution. That voluntary after-tax solo 401k contribution is very similar to Roth solo 401k contributions in that the contributions go in on an after-tax basis. However, it's different in that you have the option to contribute all the way up to the overall limit of $70,000 for tax year 2025, for example, as a voluntary after-tax solo 401k contribution, provided you have enough net self-employment income, of course. If you do make that overall contribution of $70,000 to the voluntary after-tax solo 401k account, you will have used up your overall contribution limit, which again is $70,000 for tax year 2025 for those who are under age 50. You then convert those voluntary after-tax solo 401k funds to the Roth solo 401k or the Roth IRA. So in short, the voluntary after-tax solo 401k is a way to really get over the typical Roth solo 401k contribution limit. So it's a way of supercharging your Roth solo 401k contributions indirectly by utilizing voluntary after-tax solo 401k contributions. And a caveat about voluntary after-tax solo 401k contributions is that catch-up contributions can never be made as a voluntary after-tax solo 401k contribution, but those catch-up contributions can be made as Roth solo 401k contributions. Now, catch-up contributions, there are two types for tax year 2025. There's the $7,500 amount, which applies to those who are age 50 or older. And then there's also the super catch-up amount of $11,250, which applies to a certain age group, specifically those who are age 60, 61, 62, or 63, and it only applies for tax year 2025 and future years. Therefore, it does not apply to tax year 2024. And of course, you can't make both the regular catch-up and the super catch-up. You have to choose one or the other for those who fall in that age group of age 60, 61, 62, or 63. So that's how it works from a contribution perspective. Now, from a distribution perspective, that is making distributions from the solo 401k, there are also rules that apply to distributions from a solo 401k, just like there are rules that apply to contributions to a solo 401k, as well as the types of investments that may be made through a solo 401k plan. From a distribution perspective, it depends on the type of contribution. So, for example, let's talk about pre-tax solo 401k distributions. So distributions from a solo 401k plan, specifically if we're talking about pre-tax solo 401k distributions, you have to meet a triggering event before you can distribute funds from your pre-tax solo 401k. The typical distribution triggers are age 59 and a half or older, no longer self-employed, or upon death of the solo 401k participant, as well as plan termination. So unless you meet any of those triggering events, you typically cannot distribute pre-tax solo 401k funds. Now, there are also specific triggering events that apply to pre-tax employer contributions. Those can typically be distributed from the solo 401k plan once you've had those pre-tax funds in the solo 401k plan for at least 5 years, for example. or if you've had them in the plan for at least 2 years. But more specific, if you've had a solo 401k plan for 5 years, then you can distribute those pre-tax employer contributions. Or if those employer pre-tax contributions have been in the plan for at least 2 years, they can be distributed. Of course, you're going to have to pay federal taxes on that distribution, and also a 10% penalty if you're under age 59 and a half, and possibly state taxes depending on your state of residence. Now, the employee pre-tax solo 401k contributions, those can only be distributed if you are age 59 and a half or older, or if you're closing the plan down because you're no longer self-employed, or upon your death. With respect to Roth solo 401k contributions, those can be distributed along the same lines. If it's an employee Roth solo 401k contribution, you have to wait until you're age 59 and a half before you can distribute those Roth solo 401k funds. That is, take a distribution of those employee Roth solo 401k contributions. If it's an employer Roth solo 401k contribution, then those can be distributed once they've been in the plan for at least 2 years, and or if you've had funds in that Roth solo 401k employer Roth solo 401k piece for 5 years. However, it is going to be taxable unless you've had them in there for 5 years and are age 59 and a half. So the distribution rules can get really convoluted based on the contribution type. Now, the voluntary after-tax solo 401k contributions, those can be distributed anytime. However, the purpose of making those voluntary after-tax solo 401k contributions is to actually convert those to the Roth solo 401k or the Roth IRA. It's not for the purpose of taking a distribution from them. Looks like we've got a question here. Let's take a look at that question, and then we'll continue with our topic here. Today's topic is a solo 401k taxable? The question is, what happens if you contribute voluntary after-tax money for tax year 2023 and intended to do a Roth conversion, but you forgot to file 1099-R? Can you still do the 1099-R for tax year 2023 and have the conversion count for 2023 if possible? Good questions. So if you did not convert those funds in 2023 to the Roth solo 401k or the Roth IRA, then it cannot count for tax year 2023, because conversions are reportable in the year that the funds are actually moved from the voluntary after-tax solo 401k to the Roth IRA or the Roth solo 401k. So for example, let's say Sally is self-employed. She opened a solo 401k plan in tax year 2023. The plan allowed for voluntary after-tax solo 401k contributions. Let's say Sally made a $50,000 voluntary after-tax solo 401k contribution in 2023, but she did not convert those funds to the Roth solo 401k or the Roth IRA until 2024. Well, it'll count as a conversion occurring in tax year 2024, requiring a Form 1099-R to be issued for 2024, not for tax year 2023. Let's do another example. Let's say same scenario, Sally, but in this scenario, Sally made the voluntary after-tax solo 401k contribution in 2024 for 2023 by her business tax return due date in 2024. So the contribution was made in 2024 for tax year 2023. Sally then converted those voluntary after-tax solo 401k funds in 2024 to the Roth IRA or the Roth solo 401k. That's going to count as a conversion occurring in tax year 2024, not in 2023. So if you did not, so the key is that you had to have converted those funds over to the Roth solo 401k or the Roth IRA. That means they were deposited from the voluntary after-tax solo 401k to the Roth solo 401k or the Roth IRA. So the 1099-R would not apply unless you had actually converted those funds. If those funds did get converted, then yes, the Form 1099-R can be issued late after the fact. The IRS may charge you a penalty for filing that Form 1099-R late, but yes, you'll need to make sure that it still gets issued so that you get credit for that conversion if you, in fact, did convert those funds in tax year 2023. Okay, let's take a look at, let's continue here with today's topic, which is a solo 401k taxable. We're actually almost done with our topic for today. Go ahead and shoot over any other questions you have in the meantime. Okay, so as we were discussing here, we were talking about distributions. Now let's talk about required minimum distributions. That's also another subset of today's main topic, which is a solo 401k taxable. So from a taxable perspective, require minimum distributions, which apply to those who are age 73, which is the milestone where the government wants to start collecting tax revenue by forcing solo 401k participants to start making distributions from their solo 401k. So again, it applies once you reach age 73. It only applies, however, to pre-tax solo 401k funds in the plan. It does not apply to Roth solo 401k funds in the plan. You have Secure Act 1.0 to thank for that. That is, it used to be that you had to make require minimum distributions from your Roth solo 401k. Well, that's not the case anymore, resulting in putting the Roth solo 401k on par with Roth IRAs, which are also now subject to require minimum distributions. So therefore, only pre-tax solo 401k funds are subject to require minimum distributions, not Roth solo 401k funds. When you take a require minimum distribution from your pre-tax solo 401k plan, it's going to be a taxable event, so federal taxes will apply. However, state taxes may not apply depending on your state of residence. And of course, a 10% penalty does not apply because you are well over age 59 and a half. So again, require minimum distributions only apply to pre-tax solo 401k funds once you reach age 73. It does not apply to Roth solo 401k funds. Of course, the required minimum distribution does apply once you pass away and those funds are inherited by your beneficiary. The beneficiary is going to have to start taking distributions, but that's a whole other topic. All right, let's see if we have any other questions now that we've come to our end of our presentation regarding today's topic, which is as a solo 401k taxable. It looks like we have another question here. Can you touch on the 50-year-old catch-up again? Did you say it doesn't apply to Roth portion? So the age 50 is the catch-up contribution amount. So you can make additional contributions to a solo 401k plan if you are age 50 or older. So for example, for tax year 2025, the catch-up amount is $7,500. That catch-up amount, of course, you have to have enough net self-employment income to justify that catch-up amount of $7,500. That $7,500 can never be applied as a voluntary after-tax solo 401k contribution because the regulations do not allow for the application of catch-up contributions as a voluntary after-tax solo 401k contribution. However, you can apply it as a Roth solo 401k contribution, which is another solo 401k contribution type. We also discussed earlier about the super catch-up contribution that only applies to those who are age 60, 61, 62, or 63, where they can contribute $11,250 as a catch-up contribution instead of $7,500. So not both. So that super catch-up contribution also cannot be applied as a voluntary after-tax solo 401k contribution. However, it can be applied as a Roth solo 401k employee contribution. All right, great questions today. I've enjoyed our time here today. We'll be back again tomorrow with another topic. Until next time, have a great rest of the day.